Hello everyone, welcome to lecture 2 of valuation of goodwill. Now since in the last Zoom session we have already understood how to find goodwill by various methods other than the first one, that is super profit, capitalization and annuity method. Today we take up with the practical questions based on capital employed and the goodwill by other methods. First, all of you take out question number 2, that is exclusively to understand how to find capital employed. In this question we'll just understand how to find capital employed. The financial position of ABC Manufacturing Company Limited discloses the following as on 31/3/2019. Now we will be finding capital employed by indirect method. So in indirect method we have to take fair value of all the trade assets. Fair value of all the trade assets minus fair value of external liabilities. External liabilities means, will 90,000 equity shares of 10 each fully paid be subtracted? No. It is not an external liability. It is a liability towards the owner. Will capital reserve be subtracted? No. That is again belonging to owners of the company. It's reserves and surplus. Okay. Profit and loss accounts credit balance also belongs to the owners of the company. Provision for taxation, all of you put tick on that. That is an external liability. Sundry creditors, all of you put tick on that. That is an external liability. Now I told you goodwill itself will not be included for the valuation of goodwill. So goodwill will not be taken into consideration as a part of trade assets. Land is a trade asset. Plant and machinery is a trade asset. Trade asset means the assets which are used in business. Stock at cost is a trade asset. Book debts means debtors. Debtors are also trade assets. And cash at bank is trade assets. So when we say fair value of all the trade assets, it will include land, plant and machinery, stock at cost, book debts and cash at bank. When we say minus external liabilities, it will include provision for tax and sundry creditors. Additional information, current years adjusted profit after taxes 1,65,000. This will help us in finding the average capital employed. We have seen three methods are there. So in second and third method, half of current year's adjusted profit after tax is to be added and subtracted. There it will be used. And opening balance of capital employed is 9 lakh will be used in first method to find average capital employed. What we are supposed to find here is compute average capital employed under various methods. Various methods means three methods we have discussed. Opening plus closing divide by 2. Opening plus half of this current year's adjusted profit after tax, and closing minus half of current year's adjusted profit after tax. Those three methods we have to use. Very first of all, we find closing capital employed. All of you give the heading closing capital employed. Now, how to find closing capital employed? As we discussed, fair value of all trade assets. Okay, fair value of all trade assets. Now in fair value of all trade assets, what all will we include? Land 5,25,000. Then plant and machinery 2,70,000. No other values are given, means we assume the book values itself are the fair values. So plant and machinery 2,70,000. Okay, I repeat, no other information is given. It means the book values itself are the fair values. Stock 3,45,000. Then debtors or book debts 2,85,000. Then cash at bank 21,000. So these are all the trade assets. Now we have to get the total of all the trade assets. So do it in calculator everyone. 5,25,000 plus 2,70,000 plus 3,45,000 plus 2,85,000 plus 21,000. We'll get 14,46,000. What is this? 14,46,000 fair value of all the trade assets. Okay. From that we have to subtract. You can mark it as A, total A. From that we have to subtract fair value of all external liabilities. Okay, fair value of all external liabilities. Now in external liabilities we have two things: provision for taxation 1,65,000, provision for taxation 1,65,000, and sundry creditors 2,13,000. Okay, sundry creditors 2,13,000. So 1,65,000 and 2,13,000 will be 3,78,000. Mark it as B. Now capital employed, closing capital employed will be A minus B. Okay, closing capital employed will be A minus B. That means fair value of all trade assets minus external liabilities. So what are fair value of all trade assets? 14,46,000 minus 3,78,000. 10,68,000. What is closing capital employed? 10,68,000. So I hope everyone is clear how to find the closing capital employed. Fair value of all trade assets minus fair value of external liabilities. Now after that we have to find average capital employed by three different methods. So all of you give the heading average capital employed. First what we obtained was closing capital employed. Now what we have to find is average capital employed. Three formulas we have studied to find average capital employed. First, it is equal to opening capital employed plus closing capital employed divided by 2. Okay, opening capital employed plus closing capital employed divided by 2. Now what is opening capital employed? We obtained, or it is already given rather in the question. Opening capital employed is given, see, adjustment to 9 lakh rupees, and closing capital employed we obtained 10,68,000. So 9 lakh plus 10,68,000 divided by 2. That is equal to, do it, 9 lakh plus 10,68,000 divided by 2. 19,68,000 divided by 2, that is 9,84,000. So average capital employed by first method is 9,84,000. Now by second method we studied the formula is opening capital employed plus half of, okay, it is opening capital employed plus half of current year's adjusted profit after tax. Okay, opening capital employed plus half of current year's adjusted profit after tax. Now what is opening capital employed? Already given in the question, 9 lakh. Okay, plus adjustment 1, you are also given current year's adjusted profit after tax. So what is half of that? Current year's adjusted profit after tax, you all can see, is 1,65,000. So half of 1,65,000 we have to add in that. So 9 lakh plus. Now what is half of 1,65,000? 82,500. So 82,500, if we will add in 9 lakhs, we will get 9,82,500. Okay, so second method is also clear. Now third method we apply, that is closing capital employed minus, okay, closing capital employed minus half of current year's adjusted profit after tax. Closing capital employed minus half of current year's adjusted profit after tax. Now closing capital employed we obtained as this 10,68,000. So 10,68,000 minus half of current year's adjusted profit after tax is 1,65,000, as we did in the previous method also. So 10,68,000 minus, now half of 1,65,000 is 82,500. So 10,68,000 minus 82,500, that comes to 9,85,500. Okay, 9,85,500. So you can see all the three figures are different of average capital employed. If you apply the formula of opening plus closing divided by 2, then what you get is 9,84,000. If you apply opening plus half of current year's profit, you get 9,82,500. If you apply closing minus half of current year's profit, then you get 9,85,500. However, as I already discussed with you earlier, we will be always using this method in our practical questions wherever required. And also we discussed that if nothing is mentioned in the question, you use average capital employed only. But if specifically it is mentioned in the question to use closing capital employed, then you use closing capital employed. So now let us practice the question on goodwill. Look at question number 4. Okay, all of you look at question number 4. We take up with main questions on goodwill. Now all the remaining methods, mixed questions, are covered, and all the methods we have already understood. You just remember one thing: in simple profits method we require only one working, average future maintainable profits. In all the other three methods we require two workings, average future maintainable profits as well as capital employed. After that only we will start with the formulas. So question 4. The following information of Krishna Enterprise Limited is made available to you. You all can see profits are already before tax, and we discussed this in one of the notes. In case of average future maintainable profits, that all adjustments should be made in profit before tax, and tax should be subtracted at the end after making all the adjustments. So that is what we are going to do over here. Profit before tax 1,50,000, 2 lakh, 3 lakhs and 4 lakhs. Now weights are already given, that indicates that we have to apply weighted average method only. Okay, weights are already given means we have to apply weighted average method. And tax is assumed to be 30.9% for first 2 years, 7.75% for third year, and 26% for fourth year. So first we'll make all the adjustments in profit before tax, and at the end we'll subtract tax rate, and then we'll get adjusted profit after tax. Now the closing capital employed as on 31st March 2019 is 13,50,000. So this closing capital employed what we obtained over here is directly given. This amount of closing capital employed is directly given, means in this question we don't have to find closing capital employed by doing fair value of trade assets minus external liabilities. Amount of closing capital employed is directly given. The normal rate of return is 12%. So normal rate of return is also directly given, 12%, and the present value of annuity of 1 rupee for 4 years at 12% rate is 3.037. So this will be used in annuity method because we have to do super profits into annuity value. So annuity value for 12% return is also directly given. Now stock was undervalued by rupees 10,000 in 2015 to 16 and overvalued by rupees 30,000 in 16 to 17. First of all, undervalued means what? Credit side. Undervalued means credit side, suppose stock is 1 lakh, then instead of 1 lakh we have taken 90,000. I have explained this earlier also. Actual value is 1 lakh. You assume the figures of other expenses and incomes to understand this concept. Suppose other incomes are 4 lakhs and expenses are 2 lakhs. Then we have taken 90,000, undervalued by 10,000 means we have taken 90,000. So what is the profit we have obtained? 4,90,000 minus 2 lakhs. We have obtained the profits of 2,90,000. Whereas if we would have taken actual value of 1 lakh, then what would have been the profits? 4 lakhs plus 1 lakh, 5 lakhs. 5 lakhs minus 2 lakhs, the profit would have been 3 lakhs. What does it indicate? We have taken undervalued by 10,000 means we have taken 90,000 and profit of 290. Whereas if we take the actual value, the profit is actually 3 lakhs, means we have to increase the profit by 10,000. So this we will add in 2015 to 16 and automatically closing stock of 15 to 16 becomes opening stock of 16 to 17. So we will also minus it in 2016 to 17. We will also minus it in 2016 to 17. Okay. Which amount? 10,000. And what will we do with this? 30,000. That is overvalued. Now opposite of it, so no need to do the practice of these figures again. Overvalued means it will become minus in 2016 to 17 and plus in 2017 to 18. Okay, so no need to practice that overvalued example again. Undervalued one you can try and see what we are supposed to do. Overvalued means if undervalued you are adding in 15 to 16 and that becomes opening stock of next year, you minus in 16 to 17. Then overvalued means you'll minus in that year 16 to 17 and that becomes opening stock of next year, so you'll plus in 17 to 18. Non-recurring income on an average basis is 4,500. Now non-recurring income means we have to minus from the profits. It is not going to occur every year, so we have to eliminate it from the profit, so you'll minus it. The profit will decrease if you remove it. And an annual charge of 5,000 should be made to cover managerial costs for the purpose of valuation of goodwill. Annual charge means you will again minus it. The profits will decrease if you make that charge to manage the business for the valuation of goodwill. So non-recurring income on average basis means in each year, all the years we have to minus 4,500. And again annual charge 5,000 means in all the years we have to minus 5,000. On 1st December 2016, 1st December 2016 means which year? 16 to 17. Okay, 1st December 2016 means which year? 2016 to 17. A major repair, big amount of repairs, major means big amount of repair was made in respect of plant for 15,000. Now which was charged to profit and loss account means we have treated it as revenue. Now when they say the said sum is to be capitalized means we should not be taking in P&L account, we should be adding it in asset as it is a major repair. So you can say capital expense is taken as revenue expense. Now we discussed if capital expense is taken as revenue expense, if you remove it from P&L account debit side, the profits of that year will increase. So this amount you will add in the profits of 16 to 17 and its depreciation you will minus in 16 to 17 also, 17 to 18 also, 18 to 19 also, all the 3 years. Okay, you all can see that we discussed in the very first Zoom session that if there is any capital expense wrongly recorded as revenue expense, there is a capitalized amount which we charge to P&L account, then add any capital expense wrongly recorded as revenue expense and its depreciation will be subtracted in the same as well as subsequent years. But you apply the logic only, you'll be able to follow that. Major repair you have taken in P&L debit side. Now the said sum is to be capitalized means we have to take it on the asset side. Instead of P&L debit side, we are supposed to take it on the asset side. If you remove 15,000 from P&L account on debit side, the profit of that year will increase. So we will add in 16 to 17's profits. And we discuss if you add that amount then its depreciation you minus. If you minus that amount then its depreciation you plus. But depreciation in same year as well as subsequent year. So if we are adding this amount its depreciation, we will minus in same year 16 to 17 as well as subsequent years 18 to 19, 17 to 18 and 18 to 19. Rate is 18.1% on WDV means reducing balance method for the purpose of goodwill valuation. So this will require a separate workings first for depreciation. First we'll have to make workings, because earlier when we did this question only 1 year was involved, but here 3 years are involved. So we'll have to find depreciation for all the 3 years by making the workings first. And mark this, very important. The capital employed may be taken as on 31/3/19. 31/3/19 means closing capital employed. 31/3/19 means closing capital employed. So in this question we are supposed to take closing capital employed only. No need to find average capital employed. Okay, in this question we are supposed to take closing capital employed only. No need to find average capital employed. I told you, if specifically given in the question take closing capital employed, then no need to find average capital employed. Further, you are required to calculate goodwill first by simple profits method, taking 4 years purchase of weighted average profit of last 4 years. Second, 4 years purchase of super profits. And third, capitalization of super profits. And fourth, annuity method. All the 4 methods are asked in the question. First we find average future maintainable profits, capital employed are directly given. Then we apply all the 4 formulas. So all of you make this table for finding average capital employed first. Pause the video and make this table. I hope all of you have made the table. So first, all of you write profits before tax. We always start with profits before tax. 1,50,000, 2 lakh, 3 lakh, 4 lakh. All of you write on the amounts. 1,50,000, 2 lakhs, 3 lakhs, 4 lakhs. Now we'll make adjustments one by one. Adjustment 1 and 2 has nothing to do with the profits. Third adjustment, undervaluation of stock in 15 to 16. Undervaluation of stock in 2015 to 16. As we discussed, what are we supposed to do with that? In 15 to 16 we have to plus, and 16 to 17 we have to minus. What amount? 10,000. In 15 to 16 we have to plus 10,000, and in 16 to 17 we have to minus, so write it in bracket 10,000. And next year there is overvaluation of stock by 30,000 in the year 16 to 17. So write overvaluation of stock in 16 to 17. Overvaluation of stock in 2016 to 17. Now this overvaluation of stock 30,000 we have to minus in 16 to 17 and plus in 17 to 18. 30,000 we have to minus in 16 to 17 and plus in 17 to 18. Then next adjustment, non-recurring income on an average basis 4,500 we have to minus it in all the years. Non-recurring income 4,500 we have to minus in all the years. Okay, 4,500 we have to minus in all the years. Then after non-recurring income we have annual charge. Okay, in the same adjustment, annual charge of 5,000 should be made. So that we have to, again, annual charge means we have to do it in all the years. So annual charge 5,000 we have to minus in all the years. Okay, 5,000 we have to minus as annual charge in all the years. Then after annual charge, adjustment 5. Now for adjustment 5, as I said, we'll have to make the workings. So all of you make this workings first for adjustment 5. You can make it after the table also. I'm making it here in the beginning. For this, plant and machinery's depreciation. See, understand it. On 1st December 2016, you made a major repair of rupees 15,000 which was to be capitalized. So you made a major repair of rupees 15,000 on 1/12/16. Now, if you talk about 1/12/16, then that comes in the year 16 to 17. That year will end on 31/3/17. So first on 31/3/17 we will provide depreciation. Now if you count from December to March, then December, January, February, March, 4 months. Here we will provide depreciation for only 4 months. So 15,000 into, the rate is given 18.1% per annum. Okay, 15,000 into 18.1% into 4 months, so 4 divided by 12. Do it everyone. 15,000 into 18.1% into 4 divided by 12. 905. The depreciation for that year comes to 905. If you minus that, then you'll get 14,095. Okay, 14,095. So this will be the book value on which date, or WDV on which date? 1/4/17. Now we have to provide depreciation for that year as well as subsequent years by reducing balance method. So 31/3/18, what will be the depreciation by reducing balance method? Now we will count 14,095's 18.1%. Now we'll count for full year. So 14,095 into 18.1% is 2511.19, means 2551. Okay, so that comes to 14,095 minus this. If you subtract, you get 11,543.8. So 544, 11,544. This will be the book value on 1/4/18. One more year, 31/3/19, 3 years we have to provide that year as well as subsequent 2 years depreciation. Now again, if you count 11,544 into 18%, what do you get? 11,544 into 18%, 18.1% rather. What 18%? 18.1%. So 11,544 into 18.1%. 2089.4. So 2089, and the value after that, just for the formality depreciation amounts only, we require 9454. Rather 9455 would be the book value on 1/4/19. Anyway, we are concerned with only the depreciation amount. So now, how will we give the effects for this? Understand it. Very first of all, as we discussed, 15,000 itself we have to plus in the year 16 to 17, because if you take it out from P&L debit side, it will get added. So major repairs now capitalized. So we will, in the year 16 to 17, we will add 15,000 first of all. In the year 16 to 17, we will add 15,000. Thereafter, depreciation on above, that we have to minus in that year as well as subsequent year. So what amounts of depreciation? 905, 2551, 2089. That's why we made this workings. First 905 we have to minus in that year. Then 2551 we have to minus in next year. Then 2089 we have to minus in last year. So these are the three amounts of depreciation which should minus in each of the years. Then capital employed may be taken on 31/3/19. So no other adjustment is affecting the profits. Now we will get adjusted profits but before tax. What we will get is adjusted profits before tax. So let us find the adjusted profits before tax first. $1,50,000 plus 10,000 minus 4,500 minus 5,000. 1,50,500. Okay, 1,50,500. Then for the second year, 2 lakhs minus 10,000 minus 30,000 minus 4,500 minus 5,000 plus 15,000 minus 905. 164,595. 164,595. Then for the next year, 3 lakhs plus 30,000 minus 4,500 minus 5,000 minus 2,551. 317,949. 317,949. And for the last year, 4 lakhs minus 4500 minus 5000 minus 2089 388411 388411. These are the adjusted profits before tax. From that we have to subtract tax. Now what are the tax rates? You can see in the question 30.9% for the first 2 years. Okay, tax rates are 30.9% for the first 2 years. So 30.9% means 1,50,500 into 30.9%. 1,50,500 into 30.9%. So that comes to 4650. 4.5 means 46505. That we have to minus tax. Okay. So what we'll get is adjusted profits after tax. That comes to 103,994, 996 or 995 rather. 103,995. Same way 164,595 into 30.9%. 50,859.8 means 860. And if we minus that, we'll get 113,735. Now next year the rate is 25.75%. Now not 30.9% but 25.75%. Here it is 25.75%. Okay. So 317,949 into 25.75%. 81872. Here we will minus 81872. And then what we will get is 236,077. Okay, and for the next year the rate is, last year the rate is 26%. You all can see here, for the last year the rate is 26%. So here we will minus 26%. So 388,411 into 26%. That comes to 100,986.8 means 987. Now that if we subtract, we'll get 287,424. Okay, so these are the adjusted profits after tax which we obtained. Now using that we have to find weighted average profits. So all of you make this table for weighted average profits now. Pause the video and make this table for weighted average profits. I hope you all have done it. First you write the years 15 to 16 to 18 to 19. 15 to 16, 16 to 17, 17 to 18, 18 to 19. Adjusted profits means profits after tax, what we have obtained at the end. 103,995, 113,735, 236,077 and 287,424. Okay, 103,995, 113,735, 236,077, 287,424. Weights, even if not given, you have to use 1, 2, 3, 4. Now weighted profits. Do 103,995 into 1. That's going to be 103,995 only. 103,995. Then 113,735 into 2. 227,470. Then 236,077 into 3. 708,231. and 287,424 into 4, 1149,696, 1149,696. Now if you do the total, then that would come to 2189392. Okay, do it once again. 103995 plus 227470 plus 708231 plus 1149696. So 2189392. And total of weights 1 plus 2, 3 plus 3, 6 plus 4 comes to 10. Okay. So now we can find the weighted average profits. All of you write down. Therefore, weighted average profits is equal to therefore weighted average profits is equal to total weighted profits divided by total weights. Total weighted profits divided by total weights. Now total weighted profits are 2189392 divided by total weights are 10. So that would come to 218,939.2 means 39 only, 218,939. Okay. Now are you given with this is step 2 what we have done, average profits. After step 1 adjusted profit, step 2 average. Now step 3 is add any future expected income, subtract any future expected expense that we are not given. So this itself becomes average future maintainable profits. Okay, this itself becomes average future maintainable profits. Now after that, the next information what we require is capital employed. So you all just write the steps and the informations required. Capital employed, we have to use closing capital employed, and that amount is directly given in the question, so we don't have to find it. So just write it down. What is the closing capital employed given in adjustment 1? 13,50,000. We just have to write it down, and that itself is used in finding the goodwill. Now we find goodwill by various methods. Okay. First, we are asked to use which method in the question? Simple profits method. Simple profits method. By simple profits method, goodwill is equal to average future maintainable profits multiplied by average future maintainable profits multiplied by number of years purchase. That is equal to average future maintainable profits we have obtained 218,939 multiplied by, in the first question the number of years purchase is given as 4 years purchase. So multiplied by 4. 218,939 multiplied by 4, that is 875,756. 875,756 is the value of goodwill by simple profits method. Now second method we are asked, super profits method. First of all, by super profits method, if we have to find goodwill, then very first of all we have to obtain super profits itself. What did I tell you are super profits? The profits which you earn over and above the other businesses. So first we find the normal profits which other businesses are earning. Normal profits is equal to capital employed into normal rate of return. Okay, this is the profits which other businesses earn. Capital employed into normal rate of return. Now, what is capital employed already given in the question? 13,50,000. Closing capital employed is what we have to use. It is mentioned in last adjustment. And normal rate of return is given as 12% in adjustment 2. Okay, normal rate of return is given as 12% in adjustment 2. So 13,50,000 into 12%, 1,62,000. Normal profits are 1,62,000 and our profits, average future maintainable profits are 13,50,000. Sorry, 218,939. Our profits are 218,939. So what are super profits? Super profits is equal to average future maintainable profits. Average future maintainable profits minus normal profits. Average future maintainable profits minus normal profits. That is equal to average future maintainable profits are 218,939, what we obtained, minus normal profits are 1,62,000. So 218,939 minus 1,62,000, that is equal to 56,939. 56,939 are super profits. Now we can just apply the formula and find the value of goodwill. Goodwill is equal to super profits into number of years purchase. Okay, super profits into number of years purchase. So super profits we have obtained as 56,939 multiplied by number of years purchase. Again, see in the question, it is 4 years purchase of super profits again. So into 4. 56,939 into 4, the value of goodwill is 227,756. Now third method, capitalization of profits method. By capitalization of profits method, directly now we have to apply the formula because capital employed is already obtained. So by capitalization method, the value of goodwill is equal to super profits divided by normal rate of return into 100. Okay, super profits divided by normal rate of return into 100. So super profits we obtained as 56,939. 56,939. Normal rate of return is 12%. So divide by 12 into 100. Do it. 56,939 divide by 12 into 100. 474,492. Here the value of goodwill comes to 474,492. Then fourth is annuity method. Now by annuity method we have to take the present value interest factor, annuity factor, to find the value of goodwill. So goodwill is equal to super profits multiplied by annuity factor value. Super profits are 56,939 multiplied by, see adjustment to, what is the annuity factor value for 4 years, will be less than 4 always, 3.037. 3.037. So 56,939 into 3.037. Here the value of goodwill comes to 1,72,924. If you round it off, 1,72,924. So this is how we have to find goodwill by all the various methods. Now in this question we have taken with the question where capital employed has been directly given. In further lectures we'll practice the question where we have to find average future maintainable profits also, capital employed also, and then we have to apply the various formulas. That'll be all for this lecture. Bye everyone. Take care. See you in the next lecture.